So if there's one thing I'm passionate about, it's not paying freaking taxes. Oh my gosh. And Mark hates it when I say that, but man, I hate paying federal income tax. Absolutely can't stand it. And I'll tell you, one of the smartest men ever to walk the planet, little guy that you might recognize by the name of Benjamin Franklin, once said, the best way to save money is the avoidance of tax. Now, so that Mark doesn't get mad at me, I'm going to stress the difference between avoidance and evasion, two very different things. But let me tell you something. I feel like I know a lot of people around the country, and I feel like, I've been very successful, had lots of great connections, and I feel like I'm a pretty good judge of who knows what they're doing when it comes to this stuff. And it took me a lot of years, I mean, a lot of years of good accountants and actually some really, really good CPAs and some really good attorneys to get to the best. And without, making it so he can't get his head out his office door later today, I will tell you, Mark is the absolute best. And I've asked him to join me today to share with you guys some end of the year tax strategies. And this is not just for real estate agents. This is for everybody. Now, we will talk about some stuff that is specific to real estate agents also. But here's the deal, guys. If you're a real estate agent today, and Mark's going to scold me for this, but I'm going to say it anyway. If you're a real estate agent today, or any kind of a real estate professional, and you own rental properties, and you are still paying federal income tax, it's because your CPA sucks, because you don't have my guy.
I can live with that one. That was okay. Yeah. That was good. You put a couple caveats in there, and I would stand behind that one wholeheartedly. So good call.
I mean, the end of the day, when you have people that know what they do, I look at it like this: like the money that I pay for taxes, or sorry, for tax prep, I should say, the money that I pay for tax prep, that's just fire prevention, right? I mean, it really what it does is it allows me to not pay federal income tax legally. And by the way, I've been audited twice in the last 3 years, and guess what? Never a problem. Why? Because these guys do it right. Mark and his guys know what they're doing, both on the legal side and on the tax side. So Mark, I really appreciate you being here to share with us today. And if there was only one flaw, and I do feel I've got to be balanced in this, and if there was only one flaw that I think I'm duty bound to point out, it's that Mark's a skier and not a snowboarder. And so other than that, he's the man. So.
Yeah, thank you. For those snowboarders out there, that might be hard for you to swallow. Well, thanks for having me today. For all of you listening, and I take it, Michael, we're on multiple platforms. We're off on YouTube here, there, and Facebook, blah, blah, blah. I only see you. I don't see chat. So I'm going to rely on you to garner any questions. And I want everybody to know we're here live. This is, Tuesday the 9th? I have to hold up a paper. So we're here live. So please submit your questions. We'll try to get to as many as we can. Next, I'm going to cover the top 5 year-end tax strategies that and frankly, I like the way you said it. I don't care if you're a realtor, a broker, a dentist, a doctor, an engineer, online marketer, NIL athlete, any of you, these 5 could work for you, maybe all 5. So we're going to talk about those. I know, Michael, you also want to go through a case study on a rental property for any of you that did purchase a rental property this year or in the throes of closing. We can talk about why it's so important you do close by December 31st and some techniques and strategies there. So I'm all yours, everybody. We do have a 25-point checklist of year-end strategies we just held recently at our law firm. It's on our website as a full hour webinar. We'll give the link out to that later. We'll give you some resources to get to everything. But these 5 strategies I think are critical. We're going to have fun. We're going to cover those. I'm going to go to the whiteboard here. Look at this, bad boy. We're going to go here.
Holy cow, you need a bigger whiteboard. That thing's huge.
Oh, it's the Vibe board. I love the Vibe board. I can just.
Do you really?
Oh, they're so cool. I can move it. I can copy it, and I can do all sorts of things and email it, and then knock out anything here. Zoom in, zoom out. It's so fun.
I'm going to have to keep up with the Kohlers and get me one. That's pretty cool.
Oh, well, I've got a switch here that's fun too. Okay, well, you lead the way and tell me what you want to talk about first, and then we can take questions on each topic, and then we'll move to the next one.
All right, so let's start with this. Everybody, as you have questions, type them in. If you have tax topics that you want to talk about, type them into the chat. I'm following the Facebook comments right now. That being said, Mark, I want to start off with something that I get asked a lot. I mean, literally almost every day I get asked this question, and I want you to take us through the math. If I am a real estate professional, and whether that's agent or appraiser or full-time investor or whatever qualifies as a real estate professional according to the IRS, and I buy a $500,000 rental property, walk us through this thing called accelerated depreciation and the math behind how much additional money do I now get to save on my taxes first year and then years 2 through 5, et cetera.
Okay, we'll do it. And I wanted to give two other side notes based on that introduction Michael gave. I am a CPA, an attorney. We have a law firm that serves clients all over the nation. And I've also been creating a Main Street Tax Pro network with now over 1,500 accountants trained on over 90 strategies, 900 quiz questions, and weekly classes with me to be on that network. We can give that to you later. I make no money on your relationship with that accountant, but we have a network where you can find an accountant that speaks Mark Kohler and Michael Hellickson. So we can set you up with that as well. And by the way, Michael getting audited twice in 3 years, holy shit, he's like a lightning rod. Our clients do not get audited. Our goal is to make sure they don't. Poor Michael, he's like, I don't know what happened.
You know what though? I gotta say this though. I actually don't mind it, because really for me, it's, first of all, I pay zero taxes. Second of all, I should say federal income tax, to be clear. But second of all, an audit for me is a 20-minute three-way call with my CPA and with the IRS, and then they deal with it all. It's Mark's guide, by the way. I don't have to deal with anything beyond that. And so audits mean nothing to me. I'd say it really doesn't bother me at all. And I'm really happy to trade not paying taxes for that. And so I'm very happy with that.
Well, good. Okay, well, let's go to the whiteboard then. And the first thing I want to point out to everybody is there's 3 real estate deals where you can get bonus depreciation. And one of them is real estate professional. So when we do our trifecta that Michael and I talk about all the time, over here you've got your operational business. Over here you may have a rental property. If you're a real estate professional, a rep, you could have a long-term rental, commercial rental, short-term rental, whatever type of real estate you want. And as you qualify as a real estate professional, we can unlock depreciation. That's option 1. Option 2, you could be a short-term rental investor and not be a real estate professional, but take advantage of the short-term rental loophole. My wife, Patty, and I are doing this. We are closing on our 4th short-term rental. We did a month and a half ago. We're putting in our 100 hours. We'll have our material participation loophole finished, and it is for rent in the next, actually 2 to 3 days. We need 3 rentals by December 31st, and we've got our write-offs. So you could be a short-term rental loophole, and that would work, and you don't have to be a real estate professional. The third is if you buy your own building, which I know Michael has done as well, as I have, and you rent it to your own company. That's called a self-rental. You don't have to be a real estate professional, nor do you have to put in 100 hours. It is the creme de la creme, because guess who your best renter is, people? It's you. So if you own a commercial rental and rent it, and you have the same ownership percentage, whatever that is, with the operator, which is typically you, that qualifies as a -4 self-rental. So in these 3 situations, we can unlock depreciation. It's not just real estate professional. Point number 1. All right, so let's say you go buy this $500,000 property, and let's go with a typical single-family home rental. Again, it could be a commercial, but it would be typically a commercial condo if you're going to be at the $500,000 range. So you've got this little rental property. It's adorable, and here it is. And the purchase price was $500,000. All right, well, when you go to do this little box around it is the land. You cannot depreciate land. So the typical allocation is going to be 20%, which can vary depending on the location. But we're going to take 20%. So we're going to start with 500 grand, and we're going to take 20% off the table. So that's going to be 100 grand that'll come off for the land. Now, your mortgage, your down payment, do not care. I don't care what your mortgage amount is. You could have bought cash. You could have put down $1. Do not care. For the tax write-off, it's all about the basis and the improvements. So 500 grand, we take out the land, you've got a $400,000 building. Now, typically, you would depreciate this over 27 and a half years, straight line depreciation. I mean, we could have fun here. Siri, 400,000 divided by 27 and a half. Your depreciation would be approximately $14,000 a year. That would be your base. Like we say, that'd be baseline. If you were to not do anything else, 14K a year, that's your write-off. Boring. We don't like that. So the strategy is, I want to take advantage of this bonus depreciation in the one big beautiful bill, 100% ability to write off any property that is 15, 7, 5, or 3-year property. Because I can't bonus depreciate the structure, like the foundation, the framing, anything that is a 27.5-year property. But think of blinds, carpet, landscaping, fencing, roof, HVAC, any of that that's 15-year, 7, 5, or 3, the one big beautiful bill says you can depreciate that all at once, accelerate that write-off, and use that write-off right here against any other income. So if I qualify under one of these 3 reasons that we talked about, this loss I can use against my S Corp K1, I could use it against a W-2, I could use it against crypto income, real estate income. This loss is unlocked. So if I can unlock a huge depreciation write-off, I can use it anywhere. And so my 1040 becomes a big smoothie. And I'm going to turn that blender on, and I'm going to use that loss on any other type of income. So we get back here and we say, okay, well, how much can I do of this? Well, we got a $400,000 building. To find out how much property is 3, 5, 7, or 15, I've got to do what's called a cost seg, a cost segregation analysis. You cannot do it yourself. Your accountant cannot do it. Your lawyer cannot do it. You have to get a third party. It has to have a site visit. I like engineering services. We use them all the time. We'll put a link out here if we need it. If Michael, you've got a contact you like, I'm cool with that. Shop around people. You're typically going to spend around $3,000. You're going to spend $3,000 for this cost seg analysis. Now, typically on a single family home, about 40% of it is going to be allocated to 3, 5, 7, 15. So if I take 40% of $400,000, that'd be 40 times 4, that's 6, that'd be 160,000, is that right? Let's do it. 400,000 times 0.4. 160,000. So we're going to take 160,000, which would be the 15, 7, 5, or 3-year property. Sometimes that's referred to as chattels. So this 160 grand, 10% of 400 times 4 is our 160. I can now bonus depreciate. So this 160 grand becomes our big write-off in year 1. So year 1, I get 160, right now, people, you get that write-off right now, 160 grand. The remaining 240 is now over 27 and a half years. 240,000 divided by 27 and a half. That's another 8,700. So now instead of 14,000 every year, you get 160 up front, and then, sorry, Siri, and then another 8,700 every year thereafter. And that becomes my new depreciation. So if we go back to our trifecta here and we say, okay, I'm going to knock this out. In fact, let's do a fresh one. So you've got an S Corp, you've got a W-2, a K1, your husband or wife has a W-2, you've got all this income over here. Let's say you've got 160 grand of income on W-2s or small business. Now we come over here to your 1040, we take your LLC that owns the rental property, and we carve out a $170,000 write-off. It wipes out your other income, and people, you are now in tax heaven, zero tax. This is called a taxgasm. It's exciting. This is like tax porn. It's so fun. And we have just written off all of our income. And what's cool is you now have cash flow from your rental property. You have future appreciation that's growing tax-free, and you're making more money over here than you would have paid probably a 30, 25% tax rate on this. Oh my gosh, there's probably 50 grand that you saved in taxes, And what do you use with that 50 grand in January or Q1? You go buy another rental and you do it again. And then you take the savings from next year and do it again. And then 5 to 10 years from now, you've got 10 properties producing cash flow, and that becomes your future wealth, not to mention the equity. And you did it all with the IRS's money. That is the secret to bonus depreciation in real estate and small business.
Okay, so this is huge, Mark. So I want to jump in and I want to ask you just really quick, a couple of things. Number one, if I'm correct, so let me add this spot so you're seeing us both here. So on that $500,000 house, my tax deduction ends up being $160,000, which is not the tax savings. I would then take that number, essentially, correct me if I'm wrong, and multiply that by whatever tax bracket I'm in, and that would be my theoretical tax savings. Is that correct?
That's correct.
Okay.
And you can match it up dollar for dollar with what you would have paid tax on. So that's why I used that example.
Right.
But yeah, your tax savings, that's just for fun, 160,000 times 25%. 40,000. So you're saving taxes of 40,000. And that's
if you're in a 25% tax bracket.
That's a 25%. Yeah. Which effective rate, is going to, because we have a graduated tax rate, 10, and then 12, 22, 30. So you're going to end up in that 25% range, the bulk of America. And so then you put state on it. Now you're in a lucky state of Washington with no state income tax.
For now.
Yeah, most people hit another 5 or 10 there. So they're at 30. But the beauty here is that if you go to buy this property, you're going to put 10% down, get creative financing, seller financing, whatever. You're going to put down 50 grand. Well, you just saved 50 grand in tax. So you're taking the 50 grand you would have given the IRS to buy the property, and now you're building wealth and cash flow. And then you do it again. And you do it again.
Exactly. Exactly. See, this is the thing that people don't realize is how valuable this can be long term. And I'm telling you, most CPAs are doing this wrong. It's funny. It's crazy to me how often I'm hearing from people saying, yeah, we didn't accelerate the depreciation on my rental properties. I'm like, first of all, and close your ears on this one, Mark. If you're using H&R Block to do your taxes, you deserve to be poor. Sorry. I'm just throwing it out there. Those guys are hacks. They have no idea what they're doing. Guys, they're going to tell you not to do this because, what if you sell the house in 5 years? Well, then you have to do depreciation recapture. Well, no, you don't. There's ways to avoid depreciation recapture too. Go ahead, Mark.
Yeah, there are. And I want to say this to everybody. The general rule is accelerate, wipe out your other income. But you also want to be strategic. There may be a situation where you're like, I've got an exit coming up on my business next year. So you could take a couple years of rentals, then cost seg them, and bundle them up and cost seg them in a following year to offset a big windfall you might be having. And you may want to, what's beautiful is you can cost seg it and then you can get surgical. You can say, I'm going to take 50 grand of it, drop me into the lowest tax bracket, still pay a little tax, then kick the rest to next year. So you can start being really strategic with your income. And if your accountant isn't having this conversation with you, you've got the wrong accountant. And people, I want to feel your pain when you walk into your accountant and go, hey, I saw this presentation with Mark Kohler on accelerated depreciation and this and this. If they don't bring you the idea, what do you think they're going to say?
That's a bad idea.
Yeah, they either have to villainize me and say Mark Kohler's too aggressive. They have to say, nope, it's a bad idea, or you don't qualify, because the one that is not acceptable in their brain is that, oh, yeah, I should have told you. So you're fighting an uphill battle. Now, if you get the lucky accountant that goes, you know what, I've watched Mark Kohler before, or they may put it on you. They may go, I had no idea you wanted to tax strategize. Let's sit down. Say, okay, well, now we're best friends again. So they may own it and say, let's get together. Because it could be on you too, people. You avoid your accountant because you think there's no options out there. You think tax is what it is. It's not. You're the captain of your ship. And if you're steering the ship the wrong way, that's ultimately on you too. You got to throw over your advisor, get a new one, and realize it is so easy to save money in this area.
I 100% agree. Okay, so if I'm understanding correctly on the cost seg piece, I should say on the accelerated piece, essentially what we're talking about is on a typical house, we're talking, the typical single family rental property is probably about 40% of the house's value in ultimate deduction. Is that a
Yeah,
rough
you're going to
kind of?
take 40% of 80%.
Or yeah, I'm sorry. Okay, 40%
Yep.
of the improvement value, not of the land. That's correct.
Right,
Yeah.
right. Yeah.
Yeah.
And then also you get to accelerate any improvements. So I would carve
Right.
that out a little different because if you're doing a short-term rental, you're going to go and throw 40, 50 grand in furnishings. So you've got to take your land off, take your building, then add in improvements, and then, take 40% of the building, then plus that, any improvements. And so there's some fun there. You can really, be surgical about
Yeah.
it.
And again, guys, it carries over. So if for any reason whatsoever you don't need all of that deduction this year, you don't need to take all of the deduction this year. You can use that deduction in subsequent years. And Mark, correct me if I'm wrong, the bill shows that the Big Beautiful Bill gives us 100% accelerated depreciation from January 19th of this year all the way through December 31st, 2030. Is that correct?
Yeah, we got a while to play with this.
Yeah, that's good stuff.
And what it does is stimulate the economy. That's the goal. And because there's a ripple effect. You go out and do this and then improve it. You just helped a furniture store. You helped a landscaper. You helped a contractor. And then they turn around and spend money at the grocery store. And so this bill has a ripple effect with the gross national product. And the government makes taxes on the domino effect. So you're not evil for doing this. The government was very intentional about this. Some people are like, oh, I can't believe you're taking advantage of this loophole. The government wants you to.
That's right.
You throw in opportunity zones on the top of this. They are creating zones where you put this on steroids.
Tell us about that. What's that look like? If you're buying in an opportunity zone, how big a difference is it?
Well, if you did the same equation in an opportunity zone, you then, if you pulled money from a capital gain somewhere to do it, you get to defer that. Then if you buy this property and hold it for 10 years, you never pay tax on it ever. And that depreciation recapture is gone forever. So they want you to go buy a property in an area that needs help and improvement. Every state, so in 2027, all the governors in the country are choosing their zones. So this is going to kick off in 1/1/28. That's when the opportunity zone is really going to come back to life because the Big Beautiful Bill says, hey, we don't know what's best in freaking King County, Washington, or Maricopa County, Arizona. You governors, you go tell us where you want investors to go, and we'll give them an incentive. It's like the perfect partnership. Heaven forbid the governors work with the White House.
That's huge. Okay, so I've got some other questions here for you, but I want to ask those once you've gone through, because you had 25 points you wanted to go through, right? I'm sorry, it's five. It's five.
Well, I'm going to do 5, and I'll tell you everybody where we're going here.
Okay.
We're going to do 5 year-end tips. And literally, people, the buzzer is December 31st.
Yeah.
If you do not take advantage of these, your accountant cannot revive these later. This is it. Now, I've got 25 of those. They kind of get smaller and smaller in scope, but then one of them could be huge for someone because you never know. But these 5, they affect almost 90% of my clients. So we're going to go over those, and then we can unpack them and go wherever you want after this. I know we're going to go a little over the top of the hour, and I'm okay with that. So number 1, we're going to talk about the S corporation. Some of you need to take your LLC and elect a retroactive S election. Some of you already have an S corp, but you got to peg your payroll before year end and how much you're going to do in payroll and call it reasonable comp. We're going to talk about should you put your spouse on payroll in that process. And so that's a big question. Number 2, we're going to talk about the solo 401k. In the One Big Beautiful Bill, it said to small business owners, if you set up a solo 401k and do an automatic enrollment provision, which is essentially the government trying to say, please save more. Please quit relying on Social Security. We need you to start saving more. So there's a solo 401k tax credit. Now, I'm truncating it down to a term of, I'll give you more detail when we go over it. But the point is, you as small business owners, you can set up a solo 401k and get a $1,500 tax credit, not a tax deduction. So you would, if we went with that 30% concept, you would need a $5,000 expense to save $1,500. So the government's giving you $500 for 3 years in a row to just set up the plan and you get a write-off to set up the plan. So you're making money to do this. Your deadline's at the end of the year. So we're going to go over that. Number 3, should you put your kids on payroll and how? So I'm talking about kids under age 18 that you've already been supporting all year long in the household. How do you take a write-off for the support of them in the household because they are helping you in your business legitimately? And then what about your 18 and olders? How do you do that? So kids, if you don't pay them before year end, you cannot manufacture this later. 4th, I want all of you to hold your family board meeting in the next 3 weeks. All of you have a family office. You do not have to have $100 million to have a family office. It is my mission in life to make sure every family knows they have a family office, they have a family board, they need to use it, treat it, and write off travel and dining during the holidays to meet with their family. And it's legit. Number 5, we've got to talk about healthcare. It is healthcare enrollment right now. Have you got your HSA plan? Are you doing an HRA? Are you doing a flexible spending account with the use it or lose it? Medical expenses are the number 1 reason for a bankruptcy in America. And small business owners feel like they're outside of the boundaries because they don't have a company plan taking care of them. I want you to shift that mindset and know you are in control and have more options than you realize, but you've got to get actively involved in the conversation. So we're going to talk about healthcare and how to get some big write-offs before year end and better manage your healthcare expenses. Those are the 5.
Dude, this is huge. And dude, let me tell you, we are, and Mark, you and I are going to be hitting the slopes, and don't worry, I wait for skiers. But we are going to be hitting the slopes during my board meeting, or I should say during part of the time that I'm there doing my board meeting in Park City. So very excited about that one. So hit it, man. Let's hear. So let's start right at the top.
I'll bring you over to Mayflower. We're season pass holders to Deer Valley. We'll put you on the bunny hill. And
they won't let my kind in there, man. We're the low class.
It's called skiing. We're going to put you on some skis and push you down the bunny hill, and then you'll feel, oh my gosh, this is real life. You know, it's like,
oh my gosh, you're killing me, man.
No baggy clothes, no smelling of pot. You know, like you're going to just love it. It's going to be amazing. The snow is carved beautifully. Okay, all right, guys,
I love it. All right, let's hit it.
S Corp. Let's go to the whiteboard. Okay, now let me read my video. I know the bulk of your followers, Michael, are in the real estate professional status. So I want to make sure as I go through this, as I talk about the realtor broker professional, know that this is an accountant, a lawyer, a dentist, an online marketer, NIL athletes. We're watching college football on Saturdays now because we have clients that are on the field filing their S Corp. If you're an NIL athlete, you're getting a 1099 from the school or the alumni association. You got to report that, and you're going to do it through an S Corp. This is crazy. It is a whole new world in college sports because of the NIL. So and some of you be like, oh my gosh, I didn't even think of that. So if you're making money on Etsy, eBay, and any type of small business, these same rules apply. But I'm going to talk to you, the real estate professional, today. So all of you should have your trifecta. And if you're a brand new realtor, you start out as a sole proprietor, then you turn into an LLC, and then you think you're done. Wrong. If you make $100,000 as a realtor this year in your LLC, you're going to pay self-employment tax of $15,000 off the top, and then another 20 to 30% based on the state you're in and federal tax. You could be spending 45% in taxes right off the top. It's criminal. And you can change that equation. So what you do is, if you are an LLC right now, we need you to convert to an S corporation. So when you make that $100,000, and by the way, people, if you've been an LLC, so this is point number 1 in the S Corp conversation. For those of you that need to convert back into an S Corp, we're going to cover that. And then for all of you that are an S Corp, I would bet 75% of you have the wrong salary level. So we're going to cover this quickly. So if you make $100,000 in an LLC, the tax is $15,000 off the top, self-employment tax. If you do an S Corp, I would take a $40,000 salary, a $60,000 draw, and you would be paying FICA on the 40, but not the 60. You're going to save $9,000. You just saved $9,000 by making the election to an S Corp. Mm-hmm. Now I know it's super expensive. I apologize. I'm so sorry. We charge $250 to do it. I know it's criminal. I apologize. But to save you 9 grand, we've got to charge something. So please forgive me. So here's how the timing works. If you have been an LLC all year long and you've been taking money, great, no problem. On paper, we're going to elect that you are taxed like an S Corp for the whole year. You are no longer going to report on a Schedule C. You're going to do an 1120S tax return. And because of making this election, you have to do a W-2. That W-2 has to be processed in the next 4 weeks. You've got to get your payroll service involved, your accountant involved, get your head involved and say, how much payroll should I take? And not let some scared stick in the mud accountant tell you it needs to be more than it should. And you're going to nail that W-2. And the more you allow to come out as profit, the more you save. And I have never had a client audited in 25 years for taking too little. I have a matrix I'll show you in a moment. So this is number one. All of you watching right now, if you're an LLC and you've made more than 50 grand net, so think you brought in about 70, you spent 20 grand on all sorts of crap. If you're around 50 grand in profit, you're a perfect candidate. Because we're going to split your payroll maybe 50-50, 35-65. We'll find that percentage. But that's step number one. Make your retroactive S election. Is Form 2553-8821. You will meet with an accountant to do it. It could be very affordable. Our tax lawyers will do it when they do your overall plan. And as part of that, it's super easy. The second piece is, what is the W-2 amount? So we've created a matrix to give us kind of a safe harbor approach. The more money you make, actually, the lower your payroll percentage is. So if your payroll percentage could be 100%, we don't want that, but we've got to take something. So we never want to let it fall below 20%. So as you make more money, your payroll will go down because what you're doing is you're making more money from your name, your goodwill, your brand. But when you're just getting started, if you're making 50 grand, we might be at a 50% allocation. So you would take 25 grand in W-2 and 25 grand in profit. You still save over $3,000. So that's workable. You're going to spend a couple grand doing a tax return for an S Corp and payroll. Now, if you start making about 150, which is your average middle income Main Street business owner, realtor, broker, small business owner in America, you're going to take about 50 grand in payroll and 100 grand in pass-through profit. You're going to save because it phases out at 184 grand. You're going to, you're going to save, 15 grand. We'll save 15 grand on that. So super powerful. So we want the more money you make, the more you save. So for any of you, step number 2, and then we'll take any questions that have come up on this. If you're an S Corp right now, you want to guess how much money have I made this year? You don't have to be exact. And you're going to call your tax advisor. If you don't have one, we can give you a network. And you're going to say, hey, I think I've made about 80 grand, 100 grand, 200 grand. I need to do my payroll report come January 1st. I need to start that process now. How much should I take? Mark Kohler's matrix, I think I'd be about here. Can you help guide me through this based on my situation? And then you dial it in. This is a chapter in my book, The Tax and Legal Playbook. I've got podcasts, videos, articles on this. This is not high risk. I'm actually reducing your chance of an audit. So that, my friends, is tip number 1.
So one of the questions that we have here, Mark, and I want to be quick about this one, but they're asking, do we file as an S Corp? Is it an S Corp filing an S Corp filing an LLC filing as a subchapter S, or is it a straight S Corp?
The filing as a subchapter S or a straight S Corp is the same thing. So anybody asking that, you're going to file an 1120S, as in small, corporation from now on.
Perfect. Good stuff.
You'll still have the LLC name. I'll still be Mark Kohler LLC or whatever, but behind the scenes, tell everybody you're an S Corp.
Okay, so essentially then, regardless, like if I've set up my LLC years ago, I can still do this S Corp election at this point.
Yes, sir. Yes, sir.
Good. Very good. Very good. Awesome. Good stuff. Okay, what's the next one?
Well, the question then becomes, and this is a good lead in to our tip number 2, is should I put my spouse on payroll? Now, a lot of people think, oh, I better put my spouse on payroll because if I don't, they are not going to get Social Security. That is wrong. That is a lie. And so in our example here, if you can spotlight me again, Michael. So we would go, and now our example starts to get some legs on it. We're going to have our S Corp here, or LLC taxed as an S Corp. And I'm going to actually make a little note to my assistant over here. Hey, can I get some more water? Thanks. Kirby, my PR manager, she's awesome. We're right next door. We're here in Phoenix, so there's some palm trees out here. I apologize. I am headed to the slopes in a week. But
I can't wait to see up there.
Is we're going to take a W-2 for the owner. That would be you. And your profit comes out as a K-1. We've already covered that. Well, what should I do about my spouse? I'll just summarize in this. Your spouse gets what's called the spousal benefit for Social Security no matter what you do. Legislators 30 years ago, 40 years ago, came up with the spousal benefit for stay-at-home moms and stay-at-home dads and said if the breadwinner goes out and makes a bunch of money and this stay-at-home spouse does not, they should still get Social Security. So if you start putting them on payroll, you have to make up for 30 years of the income, half of the income that your spouse would have earned. You got to go above that before their Social Security would increase. It will cost you so much in FICA that it is not worth putting them on payroll. So do not listen to anybody that tries to put you on payroll or your spouse because you need Social Security. It's an incompetence right there. So when do you put your spouse on payroll? There's only 2 reasons. One is for medical. We'll come to that in our tip number 5. But the most common is, I want you guys to set up a 401k. And this is a solo 401k of which you get to be the trustee. You can buy real estate. You could loan it out in hard money or notes. You could even buy crypto. You could buy anything you want in that solo 401k. And you get to dial it up or dial it down. And if the company doesn't match, you're the only employee. Now, for those of you that have employees, we would do a safe harbor 401k. The deadline for that was in October. So we'll address that next year as you stay in touch with Michael and me. But here, right now, before year end, if you set up a solo 401k, the government gives you $1,500 over the next 3 years. $500 you get $500 literally given to you to do this, plus you get a tax write-off to do it. We charge $1,000. That's the same price we've been charging for the last 4 years, $1,000. You're the trustee, and then we can choose how much we want your spouse to get paid so that he or she can fund their 401k. Let's say you go, oh, Mark, I'm going to put in 10 grand in my solo 401k. I want my spouse to put in 10 grand too. Well, then we put him or her on payroll for 11 grand, pay their FICA, put 10 grand in the 401k, zero out their W-2. You just got a write-off for 11 grand and they ended up with 10 grand in the 401k. So we can manufacture more wealth to build real estate and get a tax write-off to do it and get a tax credit to set it up. They're paying you to do this because they know Social Security is so jacked up. So this solo 401k, our deadline internally to get the paperwork done is the 15th, 5 days from now. So if you're catching this December 15th, because the IRS shuts down on December 26th for maintenance. And if we don't process your paperwork to the IRS by the day after Christmas, you're SOL.
Hold on, Mark. Saying the IRS shuts down for maintenance, isn't that kind of like saying they're taking a teacher workshop day so the teachers can work? I mean, isn't that when they just go do fun stuff with their own kids?
Yeah, it's a hard thing to justify, but when you're thinking, okay, let me see, their computer system is so out of date.
Yeah.
Anytime they take off to work on it, I'm kind of happy. But
You're not wrong. Real quick, we got a couple of quick, or actually on this topic, we've got a question from Eric Anthony, great guy, by the way. Eric asks, what if your wife is not stay at home and she also makes $100,000 or more a year?
Okay, this is a great question. The Okay, so we're going to go next level, everybody. Okay, so here's our trifecta. You've got an S Corp. You're doing your W-2 in K1. Your spouse has a W-2 up here. You say 100 grand. Okay. Typically, that spouse is going to have a company 401k. And the company 401k, almost 95% of them around the country, do what's called a 3 or 4% match. So a 3% match on your salary if you put it in. If you put it in, we'll match it. That means 100% return. We love that. So we're going to go and say, all right, if your spouse is not stay at home, but they've got the salary and they've got a 3% match, we want them to put in the 3 grand and get the match. Thank you. And now your 401k at work just doubled. Not a bad rate of return, but then they're just going to invest it in Wall Street, something you may not be excited about. So you're like, that's okay. I doubled my money. I'm already ahead. Well, this year you get to contribute up to $23,500 if you're under age 50. So your spouse that's staying home said, well, I just used 3 grand of my 23. So I've got $20,500 that I could still play with. People, you can have multiple 401ks. So you set up a 401k, put your spouse on the board of directors, which is tip number 4, where you're going to have your board of directors, board of advisors meeting. So you've got your board meeting coming up and you compensate your spouse whatever you want. This is so audit proof. It's not even funny. So you say, well, I'm going to pay my spouse 10 grand for serving on my board of directors. And you give him or her another W-2. So they have their day job W-2. They have a second W-2 for 10 grand and change. And then you say, let's put 10 grand in this 401k. So they put 3 grand in here, 10 grand in here, and you got a write-off for it, and they paid no tax on it. So now you're doubling down. This is where we start to teach the mega backdoor Roth 401k, because now we're going to stack. We're going to put your Roth IRA in here. We're going to put the deferral amount in here. We're going to put the company match, because here in your business, you get to match your employees and you choose 25%. So you put away 10 grand and then the company can match his or her 401k, another 2,500 that goes in the 401k, and you get a write-off for that. Mm-hmm. So now when it comes time to buy a rental property next year, you've already got 20, 30 grand sitting in a 401k to go buy a rental property. That's the magic there.
That's huge. Thank you very, very much for that. And by the way, what's the big advantage? And this is something I think a lot of people also wonder about. Why buy the real estate in a 401k or in a self-directed IRA instead of just buying it straight up?
Well, there are several reasons. So we go back to our trifecta. We're not going to worry about this side. So now we've divided your life into 2 sides. This is your asset side. So you've got a rental property over here that you bought for 500 grand, and you just kicked out some kick-ass depreciation of 160, right? We're back to that example. Mm-hmm. And so that's cool. But when you do sell this, if you don't get creative, you could have depreciation recapture. You would pay tax on the capital gain. You got to get creative on this, because you've ripped out all that depreciation. And if this property goes up to 750 in the next 10 years or more, you've got a built-in gain that you got to deal with. But you got all this depreciation. So pros and cons. Well, if I go over here and fund a 401k with 50 grand between mine and my spouse's income, and I got 50k to play with, I go form an LLC and buy another property for 500 grand. I used 50 grand here, bought this property in my own LLC name, and then I bought this one right down the street. I got a twofer. And I buy this one with 50 grand down, and I buy this one. Now, pros and cons. I can't take the depreciation, but guess what? I will never pay tax on the gain or the income ever. And I'm going to get a better ROI than some stupid ETF in Wall Street for 8%. Because I know I'm going to have a cash flow property paying down the mortgage, growing to 750 grand. If they grow together in the same perspective, and I've got all this cash flow over the years, it all goes tax-free back into my 401k. So Here, I get the depreciation, but got to deal with the gain. Here, I don't get the depreciation, but I never have to worry about the gain or the cash flow. So you're hedging. You're getting two buckets built. So in my book, when I say buy one rental property a year, once everybody gets on board with that, I go, well, I hate to tell you, you're going to buy two. You're going to buy one in your retirement account based on tax write-offs you generated inside your 401k. And you're going to buy another rental over here with your leftover money that you didn't pay tax on. And now you've got two buckets growing simultaneously. People, this is how the rich get richer.
Dude, that's insanity. That's absolute insanity. I love it. All right, real quick, Sean also asked, great question from Sean. If you're doing the S Corp retroactively, then do you include your income amount on the W-2 for the whole year or just the December amount?
The whole year. Because what we want to do is grab that entire year of income, because remember, you're going to pay self-employment tax on the entire amount. I don't want to just make it an S Corp here. Holy crap, I want to go grab the whole year. And I want to say all this income, no self-employment tax. I'm going to pop it into my new S Corp. And this is so allowed, so common. Freaking Joe Biden had an S Corp in 2016, and he had a book deal for 12 million. He took payroll of 800 grand. I mean, his payroll allocation was like 2%. So everybody does this. It's clean. It's not high risk. In fact, I reduce your chances of an audit. So you want to go retroactive, grab the whole year. I could go on and on.
I love it. I love it. Good stuff. Okay, I think we're ready to go to your next one.
Okay, the next one is our kids. So with our kids, by the way, I don't know if you know this, Michael, my desk is a whiteboard. It's the coolest thing I could show you. So I'm sitting here, I'm writing on my desk with my expo, and then I can go up to my vibe here. I mean, I'm just like a whiteboard guy, so I just love it. So I said, I went to the furniture store and go, take that whiteboard and put it on some kick-ass wood. And so they're like, all right.
That's awesome.
All right. So we've got two situations. Kids under age 18, I'm going to go 3. Oh, I've got a new one for you, Michael. You're going to love. Have you got grandkids yet? Where are you at on that?
No, man. Are you kidding? First of all, Austin would have to learn how to date first. But no, we don't have grandkids yet. Madison and Sawyer, they're so focused on doing mortgages that they haven't kicked any out yet. But I'm sure that's coming. So it's coming eventually.
Okay, let me give you a fair warning, because everybody, Michael's kids are in their 20s. So he's just a snowstorm and 9 months away from kids. So I'm really excited. So, I mean, you take your kids to the mountains and you're going to let them go hike tubbing. You never know what could happen. So be careful. All right. Now, those snowboarders, the snowboarder crowd, it could be crazy for you. All right. Okay. So here we go. In this situation, did I lose you? I was trying to make you laugh. I didn't.
No, I'm so sorry. I was answering questions in the chat.
All right.
I'm here, dude. I stayed off camera so people can see your whiteboard better.
All right. Okay. So here's ops and assets. I'm going to add grandkids to the mix. So kids under age 18, kids 18 and older, and grandkids. Here's the deal. If you're a business owner, 9 times out of 10, you're supporting other family members. And God bless you. You're an entrepreneur. You know that business is family and family is business. You're willing to give family members a job if they work hard. You might be helping them adult and get off. You may have kids under age 18 that you're teaching business and hard work ethic through your business opportunities, right? Quit paying taxes and paying for their stuff. Quit paying taxes and paying for soccer and music lessons. Let them pay for it themselves. Quit paying taxes and giving your 22-year-old college tuition. Quit paying taxes and funding your grandkids' future savings. Get all these people on the books compensated as a tax write-off. They're in a lower tax bracket or zero tax bracket. So we want you to shift money you were going to give away anyway to support these family members and put it on the books as a valid expense. And you have to have job roles and duties and purposes for these kids, which is very easy to have legitimately. And then you compensate them, take a tax write-off, and again, pay zero tax typically. And then that wealth is building for the future. That's the concept. But if you say you're going to pay your kids, you can't wait until April next year and say you did it. If you're going to do it, if If you're going to launder money, you actually have to launder it. So you've got to push it through the process in the next 3 weeks. So quickly, these are, again, articles, chapters, YouTube videos, and trainings of mine. I'm just going to hit the highlights. If they're under age 18, you're typically going to pay them in a Schedule C, a little family management company that provides support to your S Corp. And in providing support to your S Corp, you're going to pay the company, which is a small little side business, and then pay your kiddies. And these kiddos don't pay tax on the first $16,000 this year. That's their standard deduction. So if you pay them up to that amount, they're not even paying tax, but they need to have jobs in the business, marketing, cleaning the home office, helping with the rental property, stuffing envelopes, doing social media. That's how we pay kids under age 18. You could also pay them out of your LLC with your rental property, that $500,000 rental, and you could pay them as an other expense out of here. But the IRS says you cannot pay your kids under age 18 out of your S Corp. You've got to do it out of a sole prop or a Schedule E for your rentals. You can learn more about that later. Now, if they're 18 and older, you're going to give them a 1099. 1099. And you don't need this if they're 18 and older. This is just for under age 18. So all of my kids, mine and Patty's kids are between 22 and 31. They will all get a 1099 in their Christmas stocking this year because we've helped them in some form or fashion. If they call up and go, hey, can you give me a couple $100 for this or this? And we decide as an adulting mechanism, that's a good thing to do. Sometimes we say no. But if we help them out, I'll say, I'm going to help you out, but you're getting a 1099. Okay. Because they're going to learn how to pay tax on their income. If you don't want the income, don't ask me for it. But if you ask for it, I'm taking a write-off. So all my kids serve on the board of directors, which is going to be our next strategy here in a moment. I'll show you how to do that. Board of advisors, board of directors, super easy to implement. And all of the kids get a 1099. Now, ironically, 2 of our children have 2 children each of grandkids. So we have 2 children here that have 2 grandkids each. So I've got 4 grandkids now. Well, at my workshops, and Michael, I know you're going to be a big one of this advocate, I've had all of my grandkids on stage with me this year as I taught this concept.
Love it.
And I am compensating each one of them $2,000 for their
as actors
services.
Yeah.
But because they're my grandkids, I am paying their agent. So I'm paying this kid $4,000 on a 1099, and this kid $4,000 on a 1099, and then they are paying their 2 kids as their talent. So this is my agent for on-stage talent, and these are the actors. And they are each going to get $2,000. And what I've done is created a Coverdell IRA. I'm a big crypto fan. I know, Michael, we differ a little bit on this, but crypto IRA, and it's called a Coverdell. So it's just for college. And the contribution amount is $2,000.
Okay, so hold on a second, Mark. So you're saying it's just for college. So what if they decide not to go to college? What happens to the money?
Me, as the grantor and the trustee, can bounce it to another kid, the grandkid.
What if none of your kids want to go to college? None of your grandkids want to go to college. They're all like, nope, I'm just going to be in real estate. What now?
I would just take it out and it would be taxable with a 10% penalty. So,
ouch.
But now I can kick it down to a great grandchild. I can kick it to a kid that is age 40 that wants to go back to college. So anybody that wants to go back to college or have additional education, it's in the family, and I can start dishing it out. It is also trade school, private school for 14-year-olds and elementary school. I mean, the definition of education is very, very broad. So anyway,
okay, so hold on. That's exactly what I was going to ask you. So you said the definition is nice and broad. So, for example, coaching, would that count?
It has to be Title IX, so it would have to go through trade school, A typical, now what do you call private school for teenagers? I forgot that a lot of people get upset. They go out of public into
You talking about charter schools?
charter school. So
Yeah.
charter
Okay.
schools would qualify. Sorry, I couldn't remember the name.
Mhm.
But yeah, anything like that. But a coaching
Okay.
or continuing education would not qualify.
Got it. Perfect. That's really good information. Thank
So
you.
anyway, I'm doing that too, and that's fun. And if I would, and I can go through all the, and they could also be a partner in my next real estate deal. I don't have to have it crypto. But anyway, that's fun. So the point is, everybody, you can study up on this a little bit more. I'll take a couple questions now, if any of you have any. But when you meet with your tax advisor, and I'm going to give you all a link to do a year-end consult with one of my tax advisors in the next 2 weeks. And we're filling up, I'll tell you. And so I would hurry. I'll give you a link to our network. If you can't get with one of my tax lawyers, bounce to the network. And for a couple grand, we're going to build you a trifecta, answer all your questions, give you so many strategies, you'll be begging for more more time. Because every minute you're on a call with me, you're making money. So
Well, and guys, I can tell you this. I've had a lot of clients do this with Mark and his guys, and I've obviously done it, and I update mine every year, and it's being constantly updated by Mark's guys. And I gotta tell you, man, like you need the blueprint for how you're gonna not pay taxes and how you're going to build wealth. And this is the starting point for it. You've got to have this down. Without it, you're flying blind. You absolutely have to have it. Now, Mark, in the interest of time, I want to be respectful of your time, and I want to make sure we talk about board meeting HR. I especially want to talk board meeting because this one's happening for me in a couple of weeks.
yep.
So,
And I'm good. I'm good for another 20. I think we'll
okay,
be okay. So
good.
I love your community, so it's so easy. Okay, any
I appreciate
questions on
that.
paying kids? Anybody out there got a
I
question?
didn't see any questions on the paying kids things. It's if anybody's got any, put them into the Facebook comments or in the chat. Hang on. Okay, so yeah, so we've got Camille. If you could put that link, actually here, I'll just copy that and I'll put it in the Facebook. I'm putting a link right now. It's clubwealth.com/KKOS, clubwealth.com/KKOS, and that will be how you book a call with one of Mark's attorneys. And let me tell you something, guys. One of the oops, that just did what it didn't want it to do. KKOS. I'm telling you right now, guys, this is the best thing you're gonna do right there. You got to get on there. You got to go do the call, get the trifecta done, and then follow it and make sure that you're using that to make sure you make smart decisions on where to put the money, so that you're keeping it and making it work for you instead of letting it work for the IRS. And here's the reality, guys. Mark said it earlier. This is what every rich person does. Like this is how people go from middle class to rich, okay, is by doing this kind of planning and following the plan. So, Mark, I appreciate that. Thank you
Oh,
very
thank
much.
you. Okay, if there's no questions on kids, let's talk
Yep.
about board meeting. Now, I don't need to go to the whiteboard for this for a moment. If any of you have a question on this. So here's the first, there's several, let me say what it is and then the reasons why you want to do this. What it is when you set up an LLC or a corporation, you filed bylaws, you filed articles of organization or articles of incorporation, you have bylaws or an operating agreement, you have a corporate book, you have stock certificates, you have minutes, you have these organizational documents. Oh, some of you don't have that? You really don't have an entity. Good luck in an audit or a lawsuit. You can't just file one sheet of paper with LegalZoom and think you have an entity. I've got story after story of people in court getting blown through and sued personally because their LLC is a joke. You got to have separate checking. You got to respect it. Respect the corporate veil. Now, some of you think, well, it's an LLC, it's easier. No, it's the same damn rules as a corporation. You've got to follow corporate procedure. So, now this is a good thing. Don't be sad about this. What this means is every year you're going to have an annual board meeting. This is a meeting where typically in years past, and I'll be honest, when I first got the concept of asset protection, I'd say go to dinner with yourself, have a meeting. Oh, it's going to be a great year. Here's what we did. Here's what we're going to do. And you just take that, file it away, and maintain your book. And then it dawned on me that there was the most incredible opportunity we were missing. And that is saying, oh my gosh, I can have a family office. I can have my own family board meeting. And about 10 years ago, I caught the vision. And so I would start to call my kids together and my wife, and we'd sit down and have a board meeting. Now, Patty and I, it's funny. We had a board meeting 2 nights ago. I sent out a text. I said, alert, attention all. We are having a board meeting at 9 p.m. I have 2 topics to go over. And we had all the kids bounce onto a Zoom call. We went over 2 topics. One of them was coordinating the Christmas holidays. Where's everybody going? The other was a business issue. And then I said, and I had 3. And then I covered healthcare, because several of the kids are applying for health insurance right now and they have questions. So I want to knock out multiple birds with one stone. So anyway, but this Christmas, we're going to have a board meeting where they're in person or in Zoom. And we're going to talk about the business. And everybody, buckle up. I know this is crazy. You're going to talk about money. You're going to talk about wealth. I know. Heaven forbid.
It kills me that people don't talk about money and building wealth with their families. Oh my gosh.
Yeah. And
this is so important.
My parents took we're going to take you along with us, but they could have they did great. They could have done better though. They would take me to the rental properties and put me to work. When I was finally in college, he'd go, remember that rental property? And I go, oh yeah. Now they could have done a little better in high school, teaching me what the hell I was doing. But anyway, the point is, everybody, this is a chance for you to talk about your plans, your wealth. Michael.
I want to touch on this really quick because my family and I do this as well, and we do it at minimum once a quarter, but we actually are starting now to do, as often as possible, we try and do it once a month, where we literally sit down and guys, you're going to think this is stupid, but for those of you that know my kids, they've turned out pretty okay, right? And they're running pretty good businesses. And because of that, they're in control of their financial future, which gives them money and time freedom that you don't otherwise get. So what we do is we come together, and it's not a requirement for these meetings that Mark's talking about, but I'll tell you one of the things we do with ours is everybody brings their P&L with them, and we all hammer each other's P&L. I mean, we all go through everybody's P&L, and it's like, okay, so what do you mean you spent that on that? Are you kidding me? What a dumb expense! Like that doesn't need to be there. And hey, you're looking a little light in the marketing department. What's going on there? And so literally, guys, with putting all of our eyes on each person's business has really made a difference in each of the businesses and made it a lot easier for each of us to stay on track. The other thing that we do is we take a portion of all the money the kids make and all the money we make, right? So we have each of us owns our own businesses, right? But then what we do is, like with the kids, they get a salary out of their business, and then they get 10% of the profit. Then we take the other 90% of that profit, and guess where it goes? It goes into the family business that buys rental properties. And why is that? Because they don't need that much money. Okay, what we want to do is we want to set them up for their future. So we make sure that money is going into hard assets that are growing over time, which is a great move if you want to build generational wealth. Anyway, Mark, I didn't mean to get too sidetracked from the family board meeting, but guys, no. I can't stress enough how important talking about money with your kids is.
Absolutely, absolutely. Yeah. Now, some of you, this is important. Some of you are like, I don't have kids. I'm not married. I'm estranged from my children. I've never had that family unit. Okay, and I apologize for not saying this sooner because I didn't mean to exclude you from this conversation. Think of who you would invite to your Thanksgiving dinner. That's your board. Mm-hmm. Is it a brother or sister, a best friend? Who is it that you're going to hang out with on a regular basis? That's your mastermind group. And you're going to share your dreams, your potential, your vision. Also show them what happened last year and where you're going. Get their advice, encouragement, and be held accountable. Mm-hmm. It's crazy. So that is your board. You're going to document the process. Now,
and Mark, really quick, just for clarification too, the board doesn't have to have an ownership interest in your business. It could be a board of advisors, and they're simply giving their opinion on your business.
Oh, they do not own. We are not giving them ownership. Hell no, to the end. So, and no. But they're advisory level. They don't have to be compensated, but if you do, you just justified that compensation. So at our company, Main Street Business Services, we have actually created a questionnaire on your iPad that goes through 20 to 30 questions so that you can answer them in the board meeting. Everybody just swipe or whatever, if they're remote, whatever, and your board meeting minutes are automatically generated by our office and put into your corporate file. You can print them out, put them in your book, you're done.
Dude, send me a link to that.
I know. We just launched it this year, the whole
I
process.
can't wait to see that.
It's so amazing. And I've got a little video to send you. So but again, it's really expensive, and I apologize, everybody. It's $200 per entity. I know, it's ridiculous. But you get your minutes done, we maintain you with the state, and now let's talk about why you're doing it. Not only does it create an opportunity to connect, because being an entrepreneur can be lonely. And it can feel like you have no accountability, and you need that. It's scary at first, but that's number one. Number two, in your minutes, we put in about 9 different tax IRS accountable provisions that allows you to write off home office, auto reimbursements, healthcare strategies, writing off equipment under $2,500 without depreciation. We get all these special benefits. If they're not in your minutes and you get audited, you lose those. You literally cannot do a home office reimbursement in an S Corp unless this provision is in your minutes. This is why people lose an audit, because they're not doing this. Number 3, let's say you do get in a lawsuit and you show up in court with one sheet of paper. Is that LLC going to protect you? Hell no. And so you pull out your book, here's our minutes. By doing this meeting, you're escalating and increasing your asset protection exponentially. And so the asset protection, the tax savings, and then the big one, everybody, it's a tax write-off. Because, I'm sorry, you're flying in your kids to have Christmas with you? I thought you said you had the corporation buy your board members' airline tickets to come to the annual board meeting. Write-off. So dining, travel, hotel, Uber, transfers for at least 3 days. Day to get there, day for the meeting, day to get home. Can't write off 10 days in the Caymans. But we're going to write off 3 days of travel and dining for your board to meet together. And if you want to knock out 5 board meetings at once, great. You got 3 LLCs and 2 S Corps, do it at one. Oh, I know Michael's kids all have their own entity. They're going to hold their board meeting at the same time. So you take a half a day to talk about everybody's business and filling out all the paperwork. All your companies just lock down asset protection and tax benefits for the day. It's absolutely great.
Okay, I've got several questions, and anybody else that's got questions, feel free to type them in, but I've got several questions at this point, Mark, and this is great stuff. I'm really enjoying this. Okay, so we do the meeting. What if we want to be able, let's say we want to go skiing together while we're there, and it's going to be, instead of 3 days, it's going to be a 5-day trip, but again, the kids have their own businesses. Curious, one, can we write the skiing off as meals and entertainment like you would if you were entertaining a client, or is it not allowed to do that with board members?
Okay, there's a couple of things in there. First, location. We wrote off our board meeting last year in Park City. I think you should as well. And if you need to, have your attorney show up at the board meeting for a special gift of a new, Montclair jacket or something, I could come.
Oh my gosh!
I'm sorry. Skiers wear Montclair, but I mean, if I need a grungy Target jacket.
Oh my gosh! I knew you were going there.
Yeah, I mean, if you're going to snowboard, I mean, I'll take an oversized coat from Walmart. But anyway, but in your board, no, we literally held our board meeting in Park City last year.
Yep.
We've done Jackson Hole. We've done multiple locations all over the country. So go wherever you want to hold a board meeting. But a business day for travel is a required meeting or 4 hours. And so you can't hold a 20-minute or hour board meeting over 3 days. So you get your day of travel, your day of business, and your day of travel back. Now, I know your family. You may say, hey, we're going to take 4 hours a day and do business training, business family collaboration. We're going to take notes and be legit. So if you were to be in Park City for 5-6 days, you're going to take off the 2 days to get there. You got your middle days, and you may say, in the mornings, we're going to meet for 2 hours, and in the evenings, we're going to meet for 2 hours. And tomorrow, we're going to talk about your business, Austin. Tomorrow, we're going to talk about mom's business here, dad's business. So you could spread that out. But if you want to do multiple days, you've got to have a conference, a special guest, 4 hours. So there you go.
That's huge. Okay, so bottom line though is we could write off more days if we're doing more meetings.
Correct. But at least,
and we need a minimum of 4 hours of meetings per day to consider that a day write-offable. Now, does that mean we could write off the skiing for that day?
Okay, that was your third question. I forgot. Since the Tax Cuts and Jobs Act entertainment is not a write-off. It used to be. It was so beautiful. I loved it. Entertainment was a 50% deduction. Now, let's get clear here too, people. The airfare, 100%. Uber, transfers, Airbnb, 100%. For 2 to 3 days of your meeting, at least. Dining is 50%. So if you go to the resort, the lunch, the dinner, the bar tab, whatever, is 50% write-off, but not the skiing. So if you get on the resort and you go up to the top and you have a lunch, the lunch is a write-off. Everything, all food for those 3 days is a write-off at 50%.
But not the skiing. Okay. All right. I got you. Which sucks because those lift tickets aren't cheap anymore. But
sounds like a border. Sounds like a border. Always bitching about the ski lift price. I know.
Oh my gosh. All right. So that's great stuff. I'm really excited about the board meeting and how often are we allowed to do board meetings and do these kinds of write-off throughout the year?
As long as they're legitimate, they can be monthly. I mean, most corporations have a monthly board meeting, at least quarterly, but annual is typical for the small business owner. Now let's digress for a minute. This is something you guys should be thinking about for your rank and file if you have a little larger organization. Don't do a cruise ship. Cruise ships are very, very difficult to write off. You want to do an all-inclusive. So we've had many, many clients go down to Cabo, they get an all-inclusive, and they have 4 hours of meeting a day. Everything's off the hook. 100% write-off for all the hotel and transfers and everything, 50% for the food. So when you go to do your corporate retreats, make sure you're knocking out 4 hours of training a day, and it could be your board meeting, again, depending on how expansive you make it.
Okay, so here's a great question. Eric Anthony asked this one again. Eric, these are great. But guys, I love the questions. I wish more of you guys would ask questions. This is great stuff. Eric says, well, maybe it's a dumb question, but what if the Airbnb is yours and you charge the rent?
Excuse me. Well, now you're bringing up what I would call the Augusta rule. And
even on an Airbnb?
I have 4 Airbnbs. Here's the problem there. His name's Anthony?
It's Eric. Eric, E-R-I-K.
Eric. I apologize, Anthony. Eric.
You're okay.
Eric, you're onto something here, and there is a strategy, but I would modify it a little. Okay, so if you have an Airbnb and pay rent to yourself, you got a write-off in your corporation, but you just picked in to come up over here. So not good. We don't want to do that. Now, you are allowed to keep any rental property 100% rental as long as you don't use it more than 14 days a year for personal use. So if you're going to use it for more than 14 days, you better be paying yourself, because I don't want it to kick into a percentage rental. I want it to be 100% rental. So always make sure you're paying rent if you're over your 14 days of personal use. So another little side note. Now, let's say your corporation is going to go use this Airbnb. Well, I want to use one of those personal days, and I'm going to reimburse you for the use of that Airbnb, not as rent paid, but a reimbursement of personal use under the Augusta rule, as if it was even my own home. And I know you're very familiar with this. So what you're going to do is use the Airbnb under the 14-day exclusion as an Augusta reimbursement. So let's say your Airbnb is $500 a night with all the cleaning and all the BS, it's $2,000. All right. So now you're going to write a check from the S Corp to yourself for $2,000 for the use of the Airbnb, 100% write-off in the S Corp, 0 income to you. So moral of the story, you're onto it, Eric, but don't call it rent. Call it a reimbursement under the personal use benefit of the
Augusta rule. Yeah. Okay. So let's make this even more complicated. This is awesome. I like this. Here's a good one. Okay. So Mark, I'm going to be your neighbor here soon. I'm looking for something in the colony there over in Park City. We're going to be spending probably $10-20 million on this house. And we're only allowed to rent it out one time per month in that neighborhood. Now, here's the deal. I'm on the road 2 weeks a month anyway, doing seminars all over the country and all this stuff. And so I've still got my personal residence in Washington. Can I make this a rental property and claim accelerated depreciation on it and still get to use it? Let's call it 1 week a month.
Okay. Well,
yeah, right?
Well, you've got the 14-day problem.
Okay.
So 1 week a month is going to kick you out by the time you get to March.
Yep.
So I would, and if you're going to spend that much time there, I think you're going to have a hard time calling this a rental property strategy. So I would, but here's the reality that a lot of people, and I would say this to you, Michael, you say you're going to be there 1 week a month.
Mm-hmm.
A lot of times people, they realize that's a lot. And I would start out with the mentality of a couple things.
Mm-hmm.
It's going to be 100% Airbnb. But see, you're in an HOA that's causing problems. So let's just say it could be 100% Airbnb. So you've already got a problem calling it a rental anyway.
That's correct.
A HOA. But let's say it could be 100% Airbnb. Go in with that mentality, because every day you're there where you're working on the rental with a log of actual improvements and working on it, that's not a personal use day. So if you're doing a remodel, slowly but surely, you're expanding, you're doing this, lawn care, I don't know. And then you get your 14 days of personal use. You might get 30 days out of the year, which could just be plenty, and still have it 100% rental. The other thing I'm going to share, and this is, I've got to be careful saying too much because Patty gets frustrated when I tell everybody the secret. Just around the corner from Mayflower, for 10 minutes away, is what is called Heber City Midway, and I know you know this. And here is our ranch.
Oh, it's blurry, but I do remember it. It is beautiful, though.
Yeah, we have a 15-acre ranch, cheaper than a condo ski in, ski out in Park City. Now, we have worked some angles to get in the know of what properties come up for sale. They never, ever hit the MLS. But if you're interested in ranch property at a 25% of the cost, there could be a huge opportunity for your family. And that's what Patty and I are doing. We're developing a ranch. We have 23 cows now. We've got horses. We're building out the property. And we are going to be a 10th of one of these monstrosities freaking on Park City. And we don't have the traffic. We've got beautiful little Midway in Heber. And it is being developed hard. Marcella, Tiger Woods Golf Course. We've got the Olympic Park locations. We've got Jordanelle, Deer Creek Reservoir, Sundance. The list goes on. The only private airport to access Park City is in Heber. It's jet after jet. It's like a freaking machine there.
The problem, though, is that you can't ski in and ski out of the ranch.
I'm sorry, you said, I didn't know you skied.
I'm sorry, snowboard in and out of the ranch. Oh,
no, if you want
I fell into that one.
You're not going to be, Colony is not ski in, ski out anyway.
Yeah, it is. Oh, yeah, 100%.
I thought the Colony was down
no.
in the valley. The Colony.
You're thinking of Promontory.
Well, yeah, or just city limit, yeah.
Or Red Ledges.
You want ski in, ski out.
It's got to be ski in, ski out. Yeah. Or snowboard in, snowboard out. Anyway, that being said, what I'm hearing though is if it's, forget the homeowner association issue. The other issue that we have, and Eric, you're facing the same issue, is that you've got to, unless you can justify, hey, I'm doing work on this property every time I'm there, I'm going to have a hard time taking advantage of that 14-day Augusta rule, because I'm going to be well beyond that usage. And so it's going to be difficult to write that off that way.
Yeah. We actually have an Airbnb in Heber now and the ranch. So when family shows up, they stay at the Airbnb. And while we're building the ranch, we can stay there and work on the Airbnb. So we've coupled the two. Let the Airbnb pay the mortgage on your personal residence.
Okay. All right. I was hoping I was going to get, yeah, Michael, it's going to be totally fine. You can totally call your, big house a rental property and get, and so the big thing I was after is the accelerated depreciation. That's really what I want.
It's tricky.
And so, okay. All right. So that's not going to happen. All right. So, time permit, do you have enough time to just give us the HRA real quick? Can we go over that?
Yeah. The last thing is healthcare. And I'll just say this too, the first year, I'll give you one other loophole. I'm sorry. I thought you bought a rental property that was exclusively a rental property in 2026. And you cost segged it and took the depreciation, and then things happened and you decided to use it personally more in 2027 moving forward. That depreciation is now locked in, taken, and you have a built-in gain but now your personal use in 27 does not affect the depreciation you took in 26.
So they don't make you go adjust that after the
You have to
fact.
recapture it.
What the see, okay, I mean that could be between a $4 and $8 million deduction right there. So dude, you just literally on this call, I'm just
Yeah, you've got
I
to
mean,
rent the
hold on,
hell
listen,
out of it.
because got to take out the land value, but let's say it's a $15 million house, right? I mean, let's just, for easy numbers, let's go 15 million, and let's subtract 20%. That puts me at 12 million, so I'm taking of that times 40%. That puts me at 4.8 million, and if I'm in you're going to saying it's going to be 25% tax bracket blended. So if I go 25%. That puts me at a $1.2 million savings in taxes on that house just first year. Bro, sign me up.
Yes, and I know Park City very well, even though I didn't know the colony. But what I mean from Park City, knowing it well, Park City is very, very privy to which areas you could Airbnb the hell out of this and which ones you can't. So that's going to be your biggest hurdle, is finding a property, because you got to go hard that first year as a rental, so you don't get the audit risk of taking that massive depreciation.
Okay, then here's another question. This is a big one. And Eric, I know you own STRs as well, so this is going to be a big one for you and whoever else is listening that owns STRs. But what if I buy the property? Let's say I close on it in December, and I only rent it. I don't even use it at all in December. I just rent it out in December.
Well, see, on the issue of this non-recapture, I know this sounds odd, but the word intention comes into play.
Gotcha. Got it.
See, as you know, with 1031 exchanges, your intention. So in December, and then you turn around, you got to show a good 12 months of rental to show the intention of what it was, and then a change of circumstance, and you're okay. But 1 month of rental is going to be a little.
Okay, this is interesting. So I might still be okay though if I rent it out. Let's say I rent it out for a week or two at a time, and I don't use it that first year, or I use it very little that first year. Then we might be okay.
You got some options. Yeah.
All right, we'll talk more when we get that far. Okay, so health benefits. Let's go, or I should say health.
Healthcare. Everybody. Okay, final point. Thanks for letting us just have fun here. And these long form interviews do open a lot of doors and topics that are typically not covered. Okay, healthcare. Number one cost in so many in retirement aged lives. Number one reason for bankruptcy. We've got to take it seriously. You can always write off your health insurance, and that's going to be written off through your S corporation. And that's critical that you do it properly. Your S Corp should pay the premium. You may go, well, it's a personal policy. Don't matter. Let the S Corp pay it. It's also going to be stated on your W-2. It's going to save you additional FICA. So you want to make sure that you're on top of your health insurance deduction. Now, for those out there that are healthy, we want to start stockpiling money away for the future. And we want a tax write-off to do it. And this becomes what's called the health savings account, which I think it is number one or two, the best tax strategies in America. It is better than the Roth IRA. You get a tax deduction on the way in, tax-free growth, and it can come out tax-free at any age, immediately even, for a qualified medical expense, which is a very broad definition. So the point is, if you're healthy, generally, we want to get a high deductible plan and sock money into that HSA, and that tax deduction is up to $8,500 if you're married, filing joint, around $42 whatever if you're single. But a married filing joint or head of household or single, this write-off is on the front page of your tax return. You cannot phase out. No matter what your income level is, you can take the write-off. It's super powerful. You can invest it in real estate. My HSA owns rental property and cows, and I'm getting a 20 to 30% return inside my health savings account. Then you can pull it out for medical at any age, at any time. That's the health savings account. They're super powerful. You can read up on them more. But if you do not choose a health savings account qualifying policy by the end of January, game over. You cannot take this write-off next year. It's going to be very, very difficult. So right now we are in healthcare enrollment period, and you do not want to wait till the last minute to do this. So it is a year-end strategy in our world, because you've got to get on the right network, depending on your state, get with a broker, and start shopping for the right type of health insurance. That is called the HSA, the first leg of 3 strategies. Any thoughts, comments, questions?
So this is interesting, and I do have a question on this one. I would assume that this is not possible with health sharing plans. Is that correct?
That's right. So the Christian healthcare sharing ministry plans, wonderful. That's like a little co-op. You don't have to. It doesn't even have to be Christian, but a family, 10 families get together and say, let's collaborate on medical expenses, and you're kind of self-insuring in this group. If you go that route, which can be cheaper than health insurance.
Which I tell you, we did, and it has been fantastic for us. We've been very happy with it.
It's a more of a cost-saving procedure than a tax strategy. But people have to be okay with the group, the network, the procedures, and catastrophic medical can be kind of a risk because these smaller groups may not be able to cover that. So
we're in a big one. We're in impact, so it's huge. So
that's cool.
Yeah.
So if you want to do the healthcare sharing ministry strategy, love it. You would not follow in any of these other tax preferred ones. So health savings account is first. Number 2 is the most common, is the flexible spending account. For any of you that have a day job or your spouse has a day job and they give you $1,000 or $2,000 or $3,000, it's $3,500 this year. That's a reimbursable expense that's tax-free to you. But if you don't use it, you lose it. So the use it or lose it plan is what's called a FSA. It's flexible. You got to just turn in your receipt, but if you don't turn in your receipt before year end, you miss out. Now there is a catch-up provision if your employer offers that, but you may not know. So you got to reach out to your employer and find out what the rules are and make sure you don't lose it. That's strategy number 2. And you can have both. You can have a health savings account and a flexible spending account. The third strategy is called the health reimbursement arrangement. Now, this is for small business owners only. And what you would create in your small business is a reimbursement plan. Now, whether you're married or single, it's going to look different, but it's unlimited. And it's tax-free income to the employee, which would be you or through your spouse. And it's a complete tax deduction at your entity level. So if you have higher than average medical expenses, now again, this is over and above health insurance premiums. They're going to be a write-off. But if you have kidney dialysis, cancer, a knee surgery, LASIK, you have, who knows, 100 things that could be going wrong. High prescription drug costs. Whatever it is, if you have typically more than $5,000 a year in out-of-pocket medical copays, deductibles, we're going to drop you into an HRA plan and reimburse all those expenses and write them off in your business. Well, that has to be done before year end. And even if we adopt this plan, dated 1/1/25, we need to get that done in the next 3 weeks and get that reimbursement done. So if you have higher than average medical expenses, we want to use an HRA plan. It has nothing to do with insurance. There's no health insurance. And it's self-administered. We do the whole plan for you for $500. We give you the plan. Here's how you run it. Knock yourself out.
So,
it can be in conjunction with the flexible spending account and the HSA. So if you're healthy, you do the HSA. If you're unhealthy, you do the HRA. If you got some money and you're wherewithal, you do the HRA and get the reimbursement and then fund the HSA for the future. You can double down. So these are wonderful strategies for everyone out there that are kind of like out of sight, out of mind when it comes to medical, but when it comes hard. So right now there's several deadlines you got to worry about. These are, again, I have a whole chapter on just healthcare in my book. You can get it on Kindle, Audible, print, articles. I've got podcasts on this. Study up, people.
Okay, for the small business owner has 20 employees. Do they have to, if they provide it for themselves and their spouse, do they have to provide it for the employees?
Yeah, so then we go what's called the QSE, Qualified Small Business HRA, and it's a different set of rules. They're still pretty powerful. We have that for our law firm and our employees, even here. In every one of our organizations, we use the HRA, QSE HRA. They're just cheaper. They're more affordable. And then we help the employees go choose their own plan, and we reimburse that. So you're going to, so bigger employers, you're going to have a kind of a modified plan. So when you talk to the tax lawyer at the office, you guys can go over that.
And that's when you get over 55 employees, I assume?
No, frankly, well, that's going to even be a different rule over 50.
Okay.
But if you have more than one employee,
Yeah.
you can't just do an HRA for yourself and screw your employee over.
Hmm.
So you would have to, there's different levels of plans you would have to start implementing based on the number of employees you have.
Okay, that's really important. All right, Eric's got a great question. He says, "Would you recommend I get an HSA and FSA plan if I get amazing health insurance through my wife's work?"
Okay, great question. I just shot a
Mhm.
video on this the other day.
Mhm.
First of all, a flexible spending account you would never do for yourself. Those
Mhm.
are big corporate plans, cafeteria plans. If they offer you one at work, use it, don't lose it. Just take it. Now, but small business owners, 99% of our small business owners are never going to implement an FSA. It's a pain in the ass. You don't want to do it.
Mhm.
You're either going to go HSA or HRA. So, flexible spending accounts, if they're given to you, take advantage of it and run. Now, second point, he says, my spouse, his wife, has a day job with great coverage. Perfect. I would ask you this, and I'll answer both answers. Are you healthy? If he says, yeah, we're pretty healthy, then your wife's going to run into work tomorrow and say, holy crap, when is enrollment? I want a health savings account qualifying plan. Then you guys could go set up an HSA plan anywhere you want. The HSA is like an IRA. You can set it up anywhere you want. All you have to do is have a qualifying health insurance plan. So she checks the box at work, done. You can go set up an HSA at directedira.com. And we'll set it. You
Mhm.
can buy crypto with your HSA. You can buy cows and rental property, whatever. So have your wife go into work and select that. If you say, Mark, no, we're kind of unhealthy. Okay, let's take advantage of the best insurance you can get. Let's stick it to the employer. Sorry, I'm an employer too. Stick it to the employer, stick it to the insurance company. You get freaking a copay, juice it up, $5, whatever copay thing, free meds, whatever. Get the best plan you can because you're going to need it. Then you go into your small business and adopt an HRA. You may even set up your own health insurance separate from hers. Who's the unhealthy one? If she's unhealthy, put her in the company plan, set up your own independent plan that's cheaper and do an HSA. You got lots of options. So hopefully that made sense.
Yeah, no, that makes sense. I love that. That's actually super helpful. And keep the questions coming, guys. Actually, we're just wrapping up, but do put your questions in the chat in the Facebook post there. And if you have questions that we don't get to today, then I'll do the best I can to get answers from Mark and his team, and I'll get them out to you. Anyway, that said, Mark, this has been huge, and there's a couple of things you've touched on that are, I know you're not going to say it, so I'm just going to throw it out there. Oh man, actually, oh Eric, I wanted to ask him about that. I can't believe I forgot. I'm glad you brought that up. I'll get to that in a second. But we're talking about Trump's new accounts for newborns and the Dells contributing $250 per kid and all this. Very interesting topic. I'm gonna ask him about that in just a second. Before we talk about that, Mark, you've touched a couple of times on using self-directed IRA, self-directed 401ks, all that. You own a company called it's directedira.com, I believe. Is that correct?
Yes. So directedira.com is our trust company that lets you set up a solo 401k, the Roth, the HSA, the Coverdell, the HSA, all of those tax preferred plans.
Mhm.
If you use directedira.com, you are able to invest in what you know best, which is
Mhm.
probably going to be real estate,
Mhm.
notes, crypto. Now, all three of those are wide open to you rather than just the typical Wall Street
Mhm.
smorgasbord. So, directedira.com, we are a huge referral partner with Michael, and you can get a discount or benefit setting up your account through our relationship. I think our
I
team.
don't know if we have a link for that or not. If we do, if we do not have a link for directed IRA yet, is what Camille was telling me. But here's the thing, guys. If you reach out to directed IRA and let them know you're with Club Wealth, and ask them to extend you the discount that we get there, they should be able to do that. And if not, then just reach out to me and I'll get you connected through the back channels, and we'll make sure
Yes,
we make that
yes.
happen for you. But here's the thing. Don't try and do it on your own. You need these guys. It's complicated, and I don't even understand it all. Don't want to understand it all. They know what they're doing. Just let them do their thing, and just. But I'll tell you that and in fact, I've got a big project I'm working on right now, and it's big bucks. But I'm curious, Mark, can you take a very small amount of money. Let's say I've got a really, let's say I'm getting into a deal and I'm using my sweat equity to get into the deal. I'm getting into the deal with stuff other than cash, but I want to be able to stuff it into an IRA so that I can take advantage of that tax-free growth and tax-free cash flow. Can I just do, if I just take, a couple $1,000 and just throw it into this project so that I can, from my IRA, can I do it that way? Or is there some kind of rule that says I have to contribute a certain amount up front?
Well, once your money is into your retirement account, whether it's a Roth, a traditional HSA, any of those, that's step one. So
Okay.
what account are we going to fund? How much can we fund? What is the strategy to get it there? Do we want a write-off? Do we want a Roth benefit? Step one. Step two is if you do choose a self-directed platform like directed IRA, and the fees are, you're not paying a percentage fee or whatever to like stockbrokers or whatever. This is your money.
Mhm.
We're just creating the platform. Our fees are very, very, they're so much cheaper than a typical brokerage house.
And it's a fee, not an ongoing commission.
Exactly. We don't
Yeah.
get commissions. It's your investments. You do whatever the hell you want.
Right.
So step two is, what do I want to invest into? So you could invest into a small business. I know you and I were talking about a project earlier.
That's the one I'm
could
talking
come with
about.
that dollar amount from a 401k. They could come from that with an IRA. They could come to it with a Roth IRA or a Roth 401k. Never pay tax at all on that income. So whether it's a small business, a syndication, a gold, silver, palladium, crypto, real estate, notes, any of that you can do with that retirement account. You just have to make sure that the one creating the LLC creates the provision to allow a retirement account, which is super easy to do, if that makes sense.
So first of all, that piece of advice probably just saved me another, oh my gosh, yeah, that's probably another 1.5 million a year easily. So thank you for that, and I'm going to share that with some of those partners in that particular business. So that's exciting stuff. All right, so back to Eric's question about these new accounts. What are your thoughts? Is it going to really happen? And if it happens, how do we make sure people can take advantage of it?
Well, I'm looking right now too. That's what I was looking up. Is the if there's income limits for families to contribute to them, and
I was assuming there would be.
I was too. And right now
Yeah.
I'm seeing no. Um,
Really?
yeah, there's covered L ESA limits, which we have a workaround for that, but there's no income limit. My concern with it is, and these are great, and Dell was trying to help for the kids from low income families and putting a big chunk of money in there. My concern with these is you cannot self-direct these accounts. These accounts are going to be managed and by a brokerage house more than likely. And I'm trying to look at all the different, which is they're generally going to be quiet on that because Wall Street's going to be so excited about these because these accounts are going to be worth a lot of money and they're going to be managing them. So my concern is the self-directing aspect, but I'm just looking at annual limit, $5,000, qualified expenses, education, first home, starting a business. Taxed as ordinary income when they come out, but they grow tax-free. Tax-free for qualified education, if you pull it out for that. Anyway, I'm still getting up to speed on these, and they're
Okay.
getting, so to be honest.
Well, and I mean, they're not out yet, right? They're not available yet. Is that
Yeah,
right?
right.
Yeah. So, and is this 2026? Is that when they're supposed to come out?
Um, they can open them in early 2026.
Okay.
Managed by
Interesting.
private banks and brokerages, Fidelity and Schwab, funded by parents, relatives. Investments must be low cost, diversified US stock index funds. It's locked down until they're age 18. And again, if they pull for college, it's tax free. If for any other reason, they pay tax when they pull it out.
Love it. Love it.
So,
Dude, that's huge. Okay, Mark.
Woo!
I can't thank you enough. I mean, we've covered a lot of ground here today. We're going to chop this up. For those of you that are watching right now, we're going to chop this up into little pieces, little bite-sized chunks on topic-specific chunks. We're going to throw it on our YouTube channel. We'll also put it in Club Wealth University. Mark is going to be speaking at Listing Agent Bootcamp in April in Nashville, Tennessee. Woo! You guys are crazy if you don't come out and see him there. You're going to have to, you want to get to know him. And thank you, Andy. Andy says, thanks for all the amazing content. My pleasure and Mark's pleasure, I'm sure, as well. Andy, thank you for that. But guys, here's the bottom line. Get to Listing Agent Bootcamp. Make sure that you meet Mark there, talk to him. Mark, how do they contact you if they'd like more info? Oh, we just gave them the attorney link, right? Can we get that link again, Camille?
Yeah, and I think Kirby's on there with us too, but there's a couple places you can all go to. If you go to markjkohler.com, markjkohler.com, you can get to the law firm from there. You can get to directed IRA from there. You get to Main Street Business from there. We have some business owner education you can get to from there. So markjkohler.com. And
I just posted that in the Facebook as well.
Yeah. And if you know that you're going straight to that law firm, just use the Club Wealth Law Firm link. It allows us to track what we're doing with Club Wealth, which is what we want. We want to continue to build that relationship. And it will offer you some discounts when you go to use the law firm service. So the law firm is there to help you in any state across the country. And it starts with an initial consult. There's no big platinum, 20 grand, whatever retainer. A couple grand will get you a consultation with tax strategies and a trifecta. It will blow your mind. So thank you so much for having me, Michael.
No, I'm really glad you took the time, Mark. And guys, I use Mark and his firms for everything. I mean, literally. And I've dealt with so many, and honestly, I've dealt with some really good CPAs and some really good attorneys. And I got to tell you, man, my default is always KKOS. That's Mark Kohler, and that's where I go. It's because they know they're the best. They're fast. They do a great job, and I know that I can trust what they say because I've trusted what they said and had people call me on it, and turns out, oh my gosh, they were right. And so, I'm really happy with that. Would that tax strategy be through you, Mark? So it's not Mark personally doing that call with you. That's a good question.
Right. We have 10 tax lawyers personally trained by me. They're fantastic. Yeah. My highest and best use is training 10 quarterbacks rather than going out on the field myself. So they are just fantastic. And then we have our network of accountants that's 500 strong right now on the Tax Advisor Network. So that's where I think my highest and best use is. And I would be a terrible appointment because I'd kick it out, kill it on the first appointment. And then you go, when's our next appointment? 3 months from now. And you're like, what the hell? So you don't want me for the long-term hand-holding. I would be terrible.
Well, and truth be told, Mark, yeah, I mean, you don't have the bandwidth to reply to everybody every Tuesday. It's just crazy how many people are trying to pull you in how many different directions. Andy, by the way, made a great comment in the thing. He said, thank you they did a great job in setting up my nonprofit. Andy's got a charity for nurses. So for those of you that are interested in that, but end of the day, they do everything, guys. Whatever, if you've got tax or legal needs, reach out to Mark and his guys, and if they don't know, if that's not what they do, they'll refer you to the right people. Yeah. But start there, start at markjkohler.com, and just let them know you came from. We don't get paid to refer you to these guys. Yep. At the end of the day, I do want Mark to know it's not a waste of time for him to come and do stuff for us like this. And so it's helpful if you let him know that you came from us. So anyway, Mark, anything you want to add?
I've got a hard start here in a minute somewhere else, so I'll.
Sounds good, brother.
Thanks, Michael. See you.
Thank you. I'll see you in a couple of weeks.
Okay, thanks, man.
You bet. All right, bye.
Club Wealth is the only coaching company on the planet that will literally guarantee that you will double your income or make at least an extra $100,000 your first year coaching with us, or we will give you 100% of your investment back. Click the link below, sign up for the appropriate tier level, and let's get you a strategy session today. And I promise you, I 100% guarantee you, promise you that you will walk away with a heart full of gratitude for the time that we took for you because you got so much value out of that call. Schedule your strategy session today. I promise you'll be glad you did.